Colin Fenton is the CEO of Curium Capital Advisors and was one of the original members of the Commodities Research Group at Goldman Sachs, where he spent 8 years. Colin, welcome back. Let me ask you about this story that you've been tracking, of all places, in Venezuela. It involves the world's largest refinery, something that you say people really haven't been paying close enough attention to. Fill us in on this.
Yeah, good morning, Eric. Well, as the climate talks stall in Copenhagen, one story that we've been monitoring pretty closely is a severe water shortage in Venezuela. And it's gotten to be so bad that it's actually about to affect oil production. Okay. And it's specifically, if you look at the Paraguay oil refinery, this is the world's largest. It's got about 956,000 barrels per day. And if we look at the rainfall patterns in Caracas, it has not rained in Caracas for 23 days heading into the dry season. Okay, so when it's not rain for 20 days, obviously they do potentially face a water shortage. How quickly might this actually begin to play out in terms of oil production, and what kind of impact might it have on global energy markets? Pretty quickly. The short story is it would not affect crude oil production. It would affect products production. The crude production is not really affected by the water level. But to put some numbers on it, in the last month, we've had about a 97% shortfall in the expected rain, and we're at about 5 meters below normal on the water level. And looking at the 956,000 barrel per day capacity that I mentioned, we could lose about 200,000 barrels per day in the global market, which would most likely affect heating oil and China in particular. Okay, but I don't know exactly how much 200 million barrels a day is. So walk us through the scenario. If, in fact, that kind of supply disappears from the market, what kind of shock can we expect in terms of prices? Okay, so basically, the water, hydro accounts for about 75% of Venezuela's power. 70% of that comes from a single dam. That goes into this refinery, the Paraguay refinery. It's the world's largest. 200,000 barrels per day is in a market of 85 million barrels per day. It's small. Venezuela, in aggregate, accounts for about 1% of refined products output in the world. But in commodity markets, as you know, everything prices on the margin. So it could propel heating oil margins, in particular in New York, to $10, $11, $13 per barrel. Okay, Colin, we've got about a minute left. I want to shift gears and talk about a call that we discussed last time. We didn't have much time for it. Sugar versus gold. Why is sugar a better inflation play? Sure. Look, sugar is so inexpensive, it's given away for free on every diner tabletop in the world. It's our favorite indicator of inflation. It's a wonderful real-time measure of what the money supply is doing to commodities, and it has gained more than 80% year to date. We still see this El Nino effect affecting sugar production worldwide. We like gold as well, but we think sugar is going to give double-digit returns in 2010. Now, you say you still like gold, so we shouldn't necessarily be shying away from gold, but sugar's a better bet in your mind. Sure, and and we direct people toward oil as well. These are all relative value trades, but you see a lot of resistance to the belief that sugar could go higher. In fact, it has broken to 25 cents per pound and above. It's the highest price since 1981. And if you look at the price in real terms, it's not unreasonable to think it could get to 50 cents per pound. All right, that's Colin Fenton. Thank you, Colin. He's the CEO of Curium Capital Advisors, joining us from Boston.